All right, everybody. Hope you are having a phenomenal start or end to the evening. Um, it is June 25th, 2025. Interesting times in the markets these days. Interesting geopolitical issues, a bunch of different things going on. We did have Carnival Cruise earnings yesterday, so I'm sure we're going to talk a little bit through that, or at least we'll have Mr. Patel talk a good way through that. As always, it's free to like and subscribe to the channel. In order to participate in the chat, you'll have to hit the subscribe button, otherwise, it won't let you. But that's that. And as always, contemplate becoming a member, although that is not required. You can just subscribe and it is completely free. Apple, $201.75. Amazon, 212. Dutch Bros, just below $70. Google, 171. So back in the 170s. Palantir hanging out at 143. Rocket Lab, skyrocketing past $30, $32.18. The S&P back above 6,000. QQQ 541. Bitcoin back above 105. We're at 108 basically. Oil back below $70 per barrel at $65. And Henry Hub gas back below $3.50. What's the fancy homemade coffee recipe these days?
I think it's Colombe. And
those are good.
My wife puts in, I don't know, I have to ask her, to be honest. She just makes me the coffee and I drink it.
There you go.
Yeah, I have no idea.
That's what I need. I need a wife to make me coffee. That's what I need. You're the real winner here today. Okay. Where do you want to jump in, my friend? There's a lot of opportunity we could chat about. For those of you guys that are just joining, this is my third hour of streaming today. I did have a great opportunity to go on to a smaller stream called the Hustle Brothers. They talk mostly about Rocket Lab, but all things space. So it's nice to hang out with them. If you guys are ever interested in, where did I come from, what my investing philosophy is, a lot of the other things that I might not talk about on a day-to-day basis when it comes to Cashflow Chronicles, it'd be a great opportunity for you to catch it over there. They are a smaller stream, but it was a really good low-key hour and 30 minutes. So it was good to hang out with Liam and Chris. And so I think when you called me, Chris, Mr. Patel, that's what I was on. And we played a little phone tag, but luckily we were able to get the stream set up for tonight.
Yeah. So a couple of things. Number one, I think we need to cover is the comment section from last week. Something very curious came up, and I was like, oh, you know what? Maybe we'll address it live on stream because I think.
Yeah, I'm not sure what you're talking about, so this will be fun.
All right, give me 1 second. Let's see. So last week we had Cashflow Chronicles 6 days ago. Okay, believe it or not, that was actually one of our popular videos, which is kind of cool. Let's go to it real quick.
Yeah, it did do well. Appreciate everybody watching.
So one of the comments that some of the people made, basically was, no. This channel feels like we're struggling. I could be 100% off, but it feels like Matt feels like Chris doesn't listen or hear him. Hopefully it works out. Fan of this channel. Okay, so a couple of things. Let me just address them real quick. I think that person is absolutely correct in one aspect of their comment, and that was that I do interrupt you a lot. And after I watched the video over again, I was like, you know what? I kind of do just glaze over Matt a lot of times. And a lot of it is because I have very opinionated, strong thoughts and my mind is running. So I need to make sure I control that and I dial that back. And the other thing was, I think we went on so many tangents in terms of trying to communicate things that I think you were talking about one thing, I was talking about one thing, and then I started interjecting just some funny humor into the mix. And some of it was for, of course, entertainment. But the other part is, it's a little bit disrespectful. So I'll say thank you to that person for bringing that up. It was helpful, even if it's something critical. I'm old enough to the point where, I don't have an ego. I understand where people come from, and, I want to make this a long-term partnership with me and Matt. And it's not just based on, streaming and YouTube and, stocks and stuff. It's also because me and Matt have developed a close friendship, beyond just, hey, how's it going? Let's talk about stocks today. So, we're going to Mexico this Friday. So we're going to meet up in Mexico. It's going to be a cool thing. We'll meet Tevis there. But I do want to take the time and just apologize to Matt, and I will do my best to not interrupt you. All right. So I will give you your respect in letting you get your thoughts out. And I will be mindful when I try to basically change the topic. It would probably still going to happen, by the way. I'm just letting you know, because yeah,
it's passion, right? And it's understandable. Yeah. I don't ever really take it personally. There are sometimes I get frustrated, but it's rare and few and far between.
Yeah.
So is that?
But it doesn't mean
I hear Chris perfectly fine. His mic isn't going in and out.
Yeah. No, I just need to, like I said, it's one of those things that I need to, get a little bit better with. So it is what it is. But like I said, we've developed over the last 3 years. We've been covering Palantir weekly, and then we started to drift over into other things. Me and Matt have a very deep analytical ability when it comes to energy. I think Matt works in the industry. I just have a personal interest in energy. And so a lot of our insights in energy are something that we're both passionate about. And it's actually one of the things that gives us some unique abilities that I don't know too many other YouTubers that cover the energy sector and know how to actually make money off of it. And so I think a lot of people here that have made money on VG and Next Decade. And even if you got into Cheniere, you probably made some good money. All of these things are a great collaboration between me and Matt. And I think that's the same thing when it comes to me and what's his name? Sam. Sam works in technology, software engineer, so he knows the thing. So, this community is full of people who work in certain industries, and collaborating with them is the joy that, it's that alpha that you get that you may not get with other channels. So, hopefully you guys respect us, you like our commentary, and you'll be members for a really long time, and hopefully make a lot of money along the way. So that's my just beginning. Sorry, I think I took a little bit too much time.
You're good, man. And as always, I always look at it as passion, and we always want to make sure that we get our thoughts in. And sometimes it's timely to interrupt, for sure. So I don't ever take it for malintent or anything like that. But yeah, as always, I think you do a phenomenal job talking with Sam. So just linked his podcast there, Hidden Edge Pod, and he does a phenomenal job. And for those of you that don't know Sam, he helps Chris immensely on Chris's Patreon and Discord, and he provides a lot of good insights and has a lot of independent thoughts. The problem with sometimes that, and I think that we bring to the table, Chris, is we do have similar aligned thoughts on certain things, but other things where I'm just like, no, dude, what are you talking about?
Mm-hmm.
I just don't agree with you, respectfully, of course, on certain things. And you do have a long-term portfolio. A lot of things that I approach are more long-term mindset. And you do bring some of that really quick swing trading in and out within a month, or maybe even 2-3 month sort of opportunities that I generally don't bring to the table, or I can't see as well. And so I think it's a lot of yin and yang, and I think a lot of people have done really well with respect to watching us. And I had somebody reach out to me yesterday. We were leaving work, and this one was particularly on Rocket Lab, but he was just like, "Hey, man, just through the great work that we're doing, and just loving chatting about it, the passion about chatting about stocks, and bringing that, and having the will and want to share with the broader audience." He was just like, "You mentioned Rocket Lab to me about a year ago, and it's obviously up massively since then." And that guy walked away with 6 figures in his pocket that he didn't have before, and small things like that. And I've had people reach out to me recently, buying houses, putting down payments, not buying houses cash or anything, but putting down payments on houses. And so I love that for the community. That's the only reason why I do this. And to be fair, I've made a lot of money listening to a lot of people in the community as well. I mean, Chris introduced Next Decade to me, and it was something that I fell in love with immediately because of my love for what I do on my day-to-day basis. And I look at LNG facilities myself, and have supplied gas to LNG facilities in the past. And so to me, I was like, wow, okay, this is up my alley. I can do some analysis on this and actually, dive deeper into this. And I didn't even know Venture Global was going public, right? I knew of them. And I always thought of them as a private company, and Chris, let me know that they were going public. So it's definitely a great partnership, and one that I hope continues to build. And We want to grow this to be something huge, and hopefully you guys will be along for the ride, and you guys can say, I remember when they were under, 2K subscribers, 3K subscribers, whatever. They only had 5,000 in the portfolio. Whatever, I'm just excited that people are along for the ride, and we can attract 200 people at a given moment to at least come and chat with us. And hopefully that'll eventually grow to thousands in the future. So interesting times, man. What the hell do you think is going on? Before we jump into maybe Carnival Cruise and everything the like, I think I want to give you kudos on something because, man, with this extended, and I want to get to Jerome in a minute, with this extended wait on cutting interest rates, it is insane to me how much I'm seeing housing prices in Austin, Houston just get cut. It's like every other day they're cutting another 10,000 here, 10,000 there. And I'm curious. I mean, I know you're looking for homes in a southern state yourself. Is that happening where you're at too, or is it just kind of unique to maybe some of these states that a lot of people flock to, Texas being a state that a lot of people flocked to during the pandemic?
Yeah, I'm actually seeing a lot of that in my area as well. There has been one major divergence though, like in terms of price cutting, there is a certain level at which people do buy homes right now. So it's, my area, if you had gone like 5 years ago, the houses were about 50% cheaper. I know that sounds like a crazy thing, but if you look in my area, it's gone pretty up significantly. Now, one of the things that I did notice though, is that the areas that have good schools, that have, like that are not crime ridden, they actually have a great police presence and a community that has like a lot of engagement from its stakeholders. Those areas are still getting bid up. Okay. Like if you go to like East Cobb in Atlanta, it's like in the northern suburbs, you are seeing price cuts, but not nearly the deep price cuts that some of the other parts of the city are getting. So I think what's happening is people are flocking to quality, right? So the thing is like that, and that's typically what happens with housing, right? People tend to move up as they get better in terms of their economics. And the thing is, the top 10% of earners right now, they're doing extremely well. So you're seeing the more affluent areas getting significantly better. But the problem is the areas that are not as good, they're dwindling right now and their inventory is swelling a lot. So that's the one thing I've noticed in my specific area, where if you live in a really good school district and like in a safe area, you're probably like safe from a giant market correction. Like you're not going to see like a 20-30% drop. Like there's enough demand out there and not enough supply for those good areas to basically maintain their pricing at what it is right now. Other parts, I could tell you there's probably going to be a 20-30% decline, and it's going to be a bloodbath at that point, when it comes to pricing. So, that's the trend that I'm seeing in my area. I'm not sure how that is, if it's a similar thing in Texas, but it's one of those things that you just have to, like right now, I would say I am on the fence about possibly buying a home. Like I'm going to go see a house tomorrow and I really like the house, but the school district is not that good. I mean, it's a good area, but the school district is not that good. Most of the people in that area send their kids to private school. So the public schools around there, just because of its locality to another couple of neighborhoods that has like a lot of low income housing, like because of that, I think the school district is not as good. So the price that I'm getting is still relatively high, but the home has everything we like. So I don't know, like it could be a hit or miss. Other parts of the city, like the northern suburbs of Atlanta, like I said, East Cobb, like if you go there and you go to like this one district called Walton High School, it's around there, or Lassiter or Pope, they are catching bids. Like they're not. And me and my wife ideally would like to live there, but the cost is one of those things that's going to be really hard for us to bear with the kind of like the scarcity mindset that I have. I'll be honest, like we could afford it, But I'm one of those people that like couldn't sleep at night knowing how big my mortgage is, even though I have the money to pay for it. It'd be like, oh my God, oh my God, oh my God. Like, are we going to afford it? And the other thing is also, it's just me and my wife. So I don't know if I could even justify it in my brain to buy a big home in that area, you know, and basically it'll be like a 5-bedroom, but like 4 of them will be empty, you know? So and the funny thing is I want to buy, even if you wanted to buy a transition home, which is what I'm also thinking about, I'm at an age right now where I can't afford to buy a transition home and then buy another one later on. So, you know, if I was in my 20s, like late 20s and stuff, then yeah, I'd probably buy like a transition home. But, you know, like me and my wife, like our in-laws are going to move in with us. So I can't even like move into a transition home. So, but the thing is, it's all dependent on when my in-laws want to move in with us also. So I'm at a point right now where there's so many moving pieces, and then my wife might be, you know, changing her job sometime soon, because like the one that she has right now is a little bit, it's a bit rough on her right now. So all of those things combined, it just brings a lot of uncertainty to my own personal situation, but that doesn't mean that I'm not looking. I'm just being a lot more cautious with the pricing and with areas. So yeah.
Yeah, I mean, I hear you about the transition. I mean, this house was a transition house for me as well. I mean, I wasn't sure if I was going to move to the Middle East at the time when I bought this house. I was thinking about taking a role in the Middle East, and unfortunately, didn't get that job. But I got a different one, which I'm very thankful for, and I'm absolutely loving. The thing that I'm kind of yeah, and I hear you about not using enough houses, right? I'm a single guy, you know. The bedroom that's behind me, behind that wall, I mean, nobody slept in that going on. I think in July it'll be over a year that nobody slept in that house, and I'm afraid it's infested with spiders because I just haven't been in it. I don't know. Maybe they, you know, I don't really know what the hell's going on in there. I say that in jest, but in reality, I mean, it's true. Like, I don't know what the hell's going on in there. There could be mice living in the closets. I really no idea. I literally haven't been in that room. So in that respect, I hear you. It's like, as much as I would love to get a nice rancher here in Houston on a quarter acre or a third of an acre, it's like, shit. I mean, I don't even use all the rooms in this house. Like, I use this. I don't even like hang out downstairs other than cook stuff from on the kitchen from time to time. I don't even sit on the couch downstairs and watch TV. I mostly just come up here onto the computer and do work or fool around on YouTube or, you know, stream and then go directly to bed. So it's interesting. It'll be, you know, I don't know. I'd like houses though. For some reason, over the past few years, I've really grew into really liking real estate, and I think it's something I'm going to continue. But this house eventually will be a rental, and I'm sure. I mean, will your condo be a rental? I don't even know. I think we've talked about it.
I don't. Nah, I'm not the type that wants to rent things. I just like, I would just take the equity and just put it back into the next house.
All
You
right.
know, we bought it at a really good price and it's gone up significantly, but you know, like it's so weird because it's enough for the two of us, but at the same time, it doesn't give you the flexibility of having a lot of people over. And you know, there's other things like I'd like we did put an offer on a house in January, if you remember. It was a house on a really nice cul-de-sac, and we got outbid by like 15K, and I couldn't even put in a backup offer. But man, it had a really nice backyard that I was like, and I saw 2 trees. I was like, bro, I'm just gonna put a hammock over there and listen to podcasts all day. Like that was the dream. And it was perfect. But you know, sometimes and the thing is, it was a good price too. So you know, so
Interesting.
yeah.
So the thesis for you was really cool to be able to see, and I know you talked about it with Sam. But you know, we're obviously 18 minutes in, and this one 19 minutes in. I don't want to go off on like a 40-minute conversation about Carnival Cruise, but for those of the people that I guess haven't been following Carnival as of yet, but yet still want to know a little bit about what happened and what you're seeing in the company and it now actually playing out. I'm curious if you could give people kind of the 5-minute elevator pitch, and maybe what I can do is quickly share the current stock price of it, so that people can kind of see what's been happening with it over the past few years. Obviously, we have the post-pandemic slight run up, and then the realization that interest rates are starting to come in, which I think is where this started to happen. But you've been buying, and it's been in this beautiful channel, up, down, up, down. You've been buying in and out of Carnival. I don't know if you've ever gotten out actually, but you've been buying.
No, I reduced some exposure when when it hit like super high a local top last January, but I didn't like it wasn't a big move. I did downshift a little bit. So the thing that with Carnival that made it really interesting is that the options when I bought them were stupid cheap. Like literally for a $15 spread, it was $2. And the funny thing is, if you just did the homework on their debt structure, you could actually see operationally how they were going to navigate the situation. The management actually mentioned it quite a few times as well. So it wasn't like a secret, but it was something that was in plain sight. And the options contracts that were out there at the time were so mispriced. Like, brother, it was beyond mispriced. So I was able to get them at a really cheap price. And, the thesis is played out. The biggest thing with Carnival is that they took on a good amount of debt during COVID to see them through. But, they have a really strong operational team who's been paying down the debt as fast as they can, growing their EBITDA while they can, just being very efficient. And because of that, their earnings have been growing. And actually, just this week, they had earnings and they beat their quarterly earnings by almost 42%. What the expectation was. And so it's a pretty good company. I mean, and long term, if you want like a good solid business that doesn't necessarily have the same risk profile as the airlines, but still has exposure to the travel and leisure sector, Carnival, Norwegian, and Royal Caribbean. Like, look at Royal Caribbean, man. That thing has just been on another level in terms of performance. These things are giant cash flow machines that basically print money, 82% in 1 year. So when I say like, hey, people, look at the cruise lines, I know sometimes people are like, yeah, but that's not a tech company. Like, like, don't you want to be in like a fast, high growth tech company? And I'm like, yeah, I do, but I have to look for opportunities too, So yeah.
Yeah, I mean, you don't always have to be, and I think I agree with you to an extent. You don't always have to be in these fancy companies to kind of make money. Although some people like it, some people are more so about appearances to an extent than actually making money. And I think people need to realize where they sit. I personally am more about making money. I don't care if I end up being right or wrong or show up like an idiot. I more so care at the end of the day about making money. That's to me why I'm personally doing a lot of these streams and stuff like that. I'm hoping that I can make people some damn money. That's really what I'm here to do. So I don't care if it's done through tech. I don't care if it's investing in a shoe company, although I don't really invest in shoe companies. If I see an opportunity to invest in one and make you damn money, that's the hope, is that I can find that and spot it out at least and make you some money. Let me just take a last screenshot here of the portfolio, then we can hop over to that briefly. So far so good with respect to that, but let me just there we go. And let me just double check.
Yeah. Can you share my screen really quickly? And I'll just kind of go over the basic outline for this thing. So if you look at Carnival Cruise Lines, one of the things that people forgot about them is that they generate a lot of revenue. These guys aren't just one brand. I think people think that Carnival Cruise is just that one company that sometimes is mentioned as the Spirit Airlines of the cruise industry. But they make good money, and they have a bunch of brands that are under them that are differentiated between luxury, like semi-luxury, and of course like the affordable vacations. But you can see here their revenue. So in 2015 they were doing about 15 billion in revenue, and it was growing nice and steady. They had an investment grade balance sheet, so they were a steady grower, of course. And then we had COVID happened, and then of course, revenue was completely dead, so they had to rely on debt to float their operations. So after that, when they started to come back, you can see this nice massive recovery, and the revenue levels have actually exceeded pre-COVID, right? So crazy level of growth that's there. And then on the other side, if you look at their operating income, it's the same thing. So operating income, it kind of flattened out, but after COVID, it's been growing and is somewhat back to normal again. And they actually have more capacity now that they're going to keep growing their operating income. Now, the operating income that they have, if you look at their interest expenses, prior to COVID, their interest expenses were about 200 million a year. Okay. That jumped all the way to 1.6 in 2021. And then in 2023, it jumped all the way to $2 billion per year. So you can see that most of that operating income that they were generating started to actually go towards, interest expenses. And this is where people are like, oh, this is a dead company. It's a dead business. Like, I wouldn't want to be in this thing. But, people have to remember that as you pay down debt, that debt that gets paid off is less debt that you have to pay for in the future. Now, one of the things that was a big alpha for anyone who was part of the Patreon at the time, and I could eventually go to it, is that if you just look at the balance sheet and you're like, oh my God, let's look at their debt. And this is what a lot of analysts do. They just go to the debt and they're like, oh, look, they have $32 billion in debt. This is a bad company to invest in. It used to be 8, now it's 32. I don't want to be in this company, right? But the thing is, if you know Carnival, like if you do just some semi-analysis on the business itself, one of the things is that a lot of their debt that they issued prior to COVID was super low interest debt. And there's a lot of incentives with new debt that gets taken on by these companies when they basically build the ships. So a lot of times what happens is you have this like ship who's got a $1 billion ship. It's a brand new ship. What these countries that are major shipbuilders, like the Netherlands, France, and Italy, what they do is they provide really low cost loans to the cruise lines and saying, look, we need jobs. We want to support our shipping industry. So here is credit that we're going to give you. You build the ship, you pay that, and then you pay us back. These guys now, if you think about it and you look at their debt structure, the debt that they had taken on during COVID was yielding almost 10%, some of their maturities. And some of their other debt was yielding 1-2%. So barely anything. So the key was, from an investing standpoint, was what if they were taking out their high interest debt? What would their interest rate expenses look like? And that's what they did. They started to do that. And if you look at their CCL Investor Relations, if you look at their, let me just see right here, the earnings presentation, it kind of highlights it, where you can see right here, their EBITDA growing, net income growing by almost 200 million. And there's one slide, this is the one that actually I was very impressed with, which is they had some goals that they had set for 2026. They exceeded those way early. So that means that all of the stuff that they were talking about, they actually did better. So, yeah, so like I said, this is a very well-run company. If you listen to one of these earnings calls, you'll totally understand how this company was undervalued. And this is actually one of the major things. So right here, as you improve your income, so you're improving your EBITDA, and at the same time you're lowering down your debt, you get the benefit of looking like a better creditor. And as you look like a better creditor, you get the benefit of getting lower interest rates. So you can see here they prepaid $350 million of 1.4%, $1.4 billion of 7.62% notes, right, due in 2026, and refinance them for $1 billion at 5.8. So that 200 and something basis point savings is huge to the bottom line, because that money just goes right to the bottom line. And so these are the kinds of things that these guys are doing, and it's amazing. They had, like I said, they've been taking out their debt, and look at this. They, in 2024 January, their debt, I mean their credit rating was BB negative. Okay, now it's BB positive. So constantly they're getting upgraded in terms of their debt. So that cost to maintain that debt goes down. I mean, this business is always going to have high levels of debt because that's what they do. They front load their earnings by building out these building out these ships, and over time they pay down that debt. So the key is, if you're earning 12, 13, 15% on your business and you're paying, let's say 10%, that means your margin is only 5. But if your interest rate goes down to, let's say 4%, now your margin is 11%. So you're making more money. And that money, once again, gets used for different things. And one of the things, of course, is lowering down its overall debt picture. And so a lot of people are starting to realize this. I think today, actually, I saw Stifel upgraded them to like their 35. Carnival Cruise. Let me see. Right here. Let me see if we can just play this real quick. Sorry.
It's on mute.
Okay.
We don't need to reshare.
Yeah, let me just reshare. It's fine. Can you see this? Hold on 1 second. Share screen. Share screen. Okay, there we go. Right here. Can you guys see this? Look at that. Look at the EPS beats that they have. So their EPS expected was 35 cents. Actual EPS above it was this. So it surprised by 46% to the upside. Where was this stupid thing? Need to go to Stifel's upgraded. Yeah. So Stifel got an upgrade. They upgraded to $34 from $33. So these are 1 year price targets. So, more than likely it'll be hopefully above 35 by the end of next year.
Interesting. Yeah, I think I think people need to recognize for that adjusted net debt to adjusted EBITDA, it's a 2-factor piece, right? So if you're increasing your EBITDA, it's going to go down. If you're decreasing your net debt. So the fact that Carnival is attacking it from both ends, I think, is why you're seeing a large jump quarter over quarter from 4.1, 3.7. Obviously, if you readjust the interest rates that you're paying on some of these loans, that hitting the bottom line, which obviously feeds into the EBITDA piece. So anyway, food for thought. But I think overall the company's going into a decent trajectory, and hopefully they can continue to pay down the debt and overall eventually get back to dividends and buybacks, which is where they were kind of pre-pandemic. And so I wanted to answer a question in the chat, and you can remind me, Chris, because when I was investing in SMCI within the last 6 months, for me, it was always a swing trade. And so we have some people in here in the chat. I don't know if they watched this one time, got involved in the SMCI trade, and are still holding on to it. But I took my opportunity when I got I forget what kind of return I got off of it, but it was a small 5-figure return. And I kind of just closed it out. I mean, it was a swing trade for me. I never was planning on holding it for the long term. I know Steven was a little bit different. I don't know if he ended up selling it or not. But for me, it was more along the lines of there was a deadline associated with reporting the SMCI previous withheld management reports that I think, if I remember correctly, it was like they weren't fully audited. The original auditor had left. They brought in a new auditor. That new auditor needed some time to go through and be able to certify the results. The results were kind of certified with very minor changes, and the stock popped. And to me, that was a sell the news event. And so I took that opportunity. And it goes to show, and this is what I want to say, but I also want to hear Chris's thoughts about SMCI, because it did pop today about 8.5%. The problem with just kind of blindly following people into trades sometimes is you have to know when they're buying and selling. And I think that's part of the problem is if you're to follow some of these YouTubers, you might buy it and have a completely different time horizon, or may not be 100% listening as to what their exit and their entry and exit was, right? You don't, when you blindly follow people, sometimes you'll forget, like, is Matt buying this for the next 2 months, 3 months, 4 months? So, for example, some people in Rocket Lab, they were excited that they went from $4 to $12 in the last 12 months. And I'm sitting there like $12 is just the beginning, and I'm still holding, and I haven't sold a single share. So it really just goes to show, when you listen to somebody or follow somebody into a trade, you really have to figure out, what are they really doing it for, and if that aligns with your investment goals or not. Because otherwise, you might make an extreme mistake and end up losing money. Same thing with Celsius. After the first quarter earnings, I was very bullish on Celsius from 25 to $40. I thought it was underpriced, and I saw the pop, and it was a short-term investment for me, not a long-term investment. And so in that respect, I took the profits on my personal portfolio, and I try to be very transparent about those things, but sometimes people aren't necessarily listening. They're just looking for a ticker symbol. Once they find one, like, sure, I'll just throw $1,000. So I just caution people that, I don't want anybody to lose money. That's never my intent. And always, this is not financial advice. It's for my own personal portfolio. I'm documenting my own personal portfolio, as is Chris, and why he thinks something is good. But my fear is that some people just look for a ticker symbol. They say, Matt's a good guy. He's a multimillionaire. He's 34. Sure, let's just follow him into something, without fully understanding the full picture of something. And so I truly hope that if you're doing that and using YouTube as a means, then you're really listening and not just blindly following somebody into something just because. And so I'm not saying that the folks that we're mentioning, SMCI, did do that, but that requires diligence. If you're following somebody, it requires you to follow them very religiously to understand what they're doing with each one of their positions. So what ended up happening with your SMCI? I think you did the same.
No, I sold out, man. I sold it like when it popped before today. So it was like a little while ago. So I sold out of it, because the thing is, like, some things get super. So here's the thing. There are times where you can believe in a company's fundamentals and think, oh my God, this is a business that has nothing but up into the right business model. And that if I buy it and hold it for the next like 20 years, I'm going to do really well. I'm going to beat the market. Other times things get oversold, and you want to basically be opportunistic, buy them when things are oversold. Some good piece of news comes out, they go up, and boom, you can sell out of it, and then, recycle that gain into something else. So, sometimes you would be strategic, sometimes you'd be long-term investor. And the thing is, you don't have to be either or. I know some people say, oh no, if you're a long-term investor, that's the way that you make money. And then others like, no, I just like day trading all the time, or I like trading. And my thing is, it's all about your personal tolerance on which side you want to be. So there are times where it makes sense to be a long-term investor, and there's other times where it makes sense to be tactical, and sometimes I see more value in being tactical. Like with Carnival, I was holding it. I'm a long-term investor in Carnival's options. I've literally been holding it since I bought it. But with SMCI, it was oversold. There's an AI wave going on. The only major problem that they really have in the short term is just some, regulatory issues with filing, and eventually they will file. And when the filing came out, it shot up, and we did well with it. So yeah. So there we are with the portfolio. Man, we're down. We're not at 11. No. You're on mute, Matt.
Sorry, thank you. Yeah, unfortunately, we did not have a good day in the market. It took us below 11,000, which I was kind of excited to get to 11. But yeah, here we are, still looking rather good in the total overall portfolio. You could see the only real stocks that were down are ABCL, which that and your beloved United Health. I will say, I think you told me to sell 50% of Oscar yesterday, and I never ended up getting around to it. So I need to put the order in. I forget what we were going to do with that 50% of Oscar, though. Was it to put in the UNH, I think?
I think we need to put it in UNH.
Yeah.
I think, like I said, to me, I see there's so much value in UNH that I think the market is missing, because they're so focused on the headline risk that, like I said, you're getting the opportunity of a lifetime to be in a company that's so ingrained into the U.S. healthcare sector. And there's so many other things that have UNH has going for it. And they've got new leadership. And some of this, honestly, I think is them just kitchen sinking their quarter because they wanted to switch things up and they just needed basically a washout so they can rebuild themselves a little. The one thing you have a challenge with when it comes to businesses, like sometimes people become too optimistic. And the thing is, management feels that, hey, wait a second, if our long-term growth trajectory is 15% per year and the market front runs it by 5 years, now you're going to have basically underperformance for the next 5 years. So how do you get around that? How do you like set expectations so that you can manage and beat them? Like right now, when I look at Palantir, I'm like, dude, the expectations of Palantir are people are paying like 2030 prices right now, if not 2035, but management says, you know what, we're going to keep high expectations and we're going to keep meeting those expectations. So in that regard, there's something there. So hopefully there's not like 70% retracement in Palantir, but look, I've seen it happen to great companies, and a 70% retracement in Palantir would still bring it back down to like what, 50 right now?
Yeah, I'm not smart.
So between 45 and 50.
Yeah. I mean, I had a good lunch with Roy. We talked about it today. Over the course of 2 hours, we talked about Palantir, and he put a post on X. Actually, he's luckily we were supposed to eat lunch tomorrow, but he's going to get a new Tesla because he's rich as fuck. No, I was kidding. But he's going to get a new Tesla, and he wanted to make sure his debt stayed flat. So for any of you guys that are interested, check out his post on X with respect to why he sold some Palantir. But I hear you, 100% agree. And him and I both, whether or not, I think he kind of agreed with what I said, which I said, I think that Palantir could handle another high 30% revenue growth quarter. But as you get to the third and fourth quarter, if there's not a 4 in front of that revenue growth, that stock is not going to handle it well. Unless something massive happens, which is like the cash flow margin grows massively or something like that truly offsets it. But I personally just don't see that. Like I honestly think you need a 4, meaning a 40% plus on the third quarter and the fourth quarter earnings. Otherwise, it is not going to handle well. But at the same time, you do have the net dollar retention showing up well, etc. But I mean, I don't want to make this the Palantir show, but I don't necessarily think. Anyway, I agree with you. 2030, 2035 plus prices is definitely what you're paying for with Palantir right now.
What's funny is Steve, every day, Steve will just randomly call me and he'll be like, have you seen what Palantir is right now? Because he's got covered calls he had rolling them all the way to like 2027. So he's like, how is this still where it is right now? And so it's just funny because the market is giving them a lot of credit. And I think of it, the thesis that that Steve has is a little bit better than mine, which is, they're just overvalued. Steve is like, they're really setting themselves up for very tough comps next year. Because like it's hard to grow double digits like that and then repeat that over and over again, and also with the backdrop of interest rates possibly getting cut. I think Morgan Stanley said 7 times next year. If we get around 5 to 7 cuts, that means that a lot of their income that they've been getting from their treasury holdings is going to go down. The one thing that people seem to forget is these guys issue a lot of shares, man, and there's been heavy dilution. And so if you just look at let me just pull it.
You heard it here first. Now, people like to continue to talk about the interest income. The bigger the company gets, the less important it is. It was important in 2022. It was important in 2023. It was important in 2024. Sorry, not 2022. 2023, 2024. In 2025 and beyond, I think the company is getting big enough now where it's digestible enough, in my opinion, for interest rates to get cut, and it's not going to have a huge impact on the stock because when revenue was much less, 40-50% less than it is now, it was a much larger portion of the net income of the group. But now I don't think it's nearly as big of an opportunity. But let's just pull up the numbers and take a look.
Yeah, I mean, so here's how much they're making. So interest expense is nothing because they don't have really any debt, right? On the other hand, if you look at their interest income, where is it? Interest in right here, interest and investment income. You can see here in 2022, they're making 20 million a year because this is on a TTM basis. Now they're doing about 203 million in interest income per year. Okay, so if you look at
trailing 12 months, not quarterly.
Right, trailing 12 months. So if you look at their net income is $570 million a year, of which 200 is coming from interest on the cash that they're holding onto their balance sheet. So you can hear short-term investments. That's what it is. They're basically holding treasury bonds. So you can see here, they've been buying a lot of treasuries. So as they get cash from their clients, they've been buying treasuries. Now, the challenge that I have here is that on the other side, if you just look at how much shares they've been issuing on a annualized basis, it's significant, right? It's almost like 700 million. So yes, on one hand, they're also kind of buying back shares also at 369 million. You can see here that they bought. But remember, because the stock is so overvalued. That's
also wrong. That number is wrong.
Which one is?
The 369 million.
On TTM basis?
Yeah.
That's wrong?
Mm-hmm.
What is it? How much are they buying back?
I don't know why it's wrong. But let me pull up my sheets.
Because Q4, according to this, they did 240 million in share buybacks. And then last quarter, they did 95 million in share buybacks.
Shares repurchased in the fourth quarter was 54 million.
54 million? So it's less than this?
Let's see. Let me just double check that is share repurchases, buybacks. Yeah, I mean, they're at most they're doing 18-ish million a quarter.
In buybacks? I thought they were doing more.
No.
Huh.
Yeah, go to the 10Q. Right. I don't know. That number's wrong. I mean, it is very far. Yeah, if you go to the 10Q, it is that's just a regular 10Q. That's not a
Palantir. Hold
on. In the total cumulative that I have for repurchases is $82 million, and on the trailing 12 month is probably closer to 60.
Cash flows. So net income is 217. Financing activities right here. Taxes paid, net cash, repurchase of common stock right here. 18.
Yep.
But this is probably so that probably means it's net though, right? This is 18 million net. So remember, these guys issue shares to what is that thing called, to their employees via RSUs, and then they also buy back shares. So I think that's what this is saying, right? Like repurchases is, well, because remember, if you look over here, proceeds from exercise of common options, they got $66 million to issue those shares, and remember those that money that they issued is going to be at a much lower price because the options that the people exercised, I think Alex Karp is getting them at like $10 or something, $10 per share. And immediately what they do is they go, they basically get those shares issued to them, and their float grows, their shares grow, but at the same time they're buying back shares. And according to this, they bought back only 18 million in share repurchases.
In the quarter, yeah. So cumulatively, since they've started the buyback program, they've bought back 2.3 million shares at an average price of $35 a share.
Huh. We gotta look. Sorry. I gotta look into that a little more. No, you're right. I have to. Man, anytime you look at these third-party sites, sometimes they're accurate and sometimes they mess things up.
Yeah, just search repurchases, and I'm sure it'll come up.
Yeah. share repurchase program right here. In August, company board authorized 1 billion company's outstanding shares the company may repurchase, stock-based compensation.
Well, you just crossed over it right above stock-based compensation.
Right here, the company repurchased or retired 0.2 million shares of its common stock, including commissions of 18 million under the share repurchase program. As of March 31st, approximately $917 million worth of shares of originally authorized amount of the repurchase program is available for future repurchases. So they still have.
I don't mean to be a stickler, but I know Palantir stock. You know,
you do.
Yeah.
You look at it way more than I do.
Yeah.
But that actually means that this is worse.
Yes.
No.
Yes.
Okay. That's bad.
And that's why I'm like, well, I'm curious. That's one of the questions I have. Is like, I'm okay with them holding $5 billion on the balance sheet, etc. But it's like, what is the goal? Because the cash flow from operations now, and this is me playing armchair quarterback, right? They made $310 million in cash flow from operations in the previous quarter, so they're trailing cash flow from ops is about 1.2 billion, right? So you mean to tell me you've bought back $70 million worth of stock, 72 million, if I guess you want to be super particular, over the past 4 quarters, and you made 1.2 billion in cash flow from operations? Like, to me, it's like that's about 5%. I would love to see like maybe 10%, 12%, like something. I would like to. I'm just kind of curious because the cash flow from operations are going to continue to grow at a massive pace. Very shortly, we'll be at $2 billion, $3 billion, $4 billion.
Yeah.
Are they going to grow that? Because the share repurchases have been pretty steady. The first quarter of 2024, they bought 9 million. The following quarter, they bought just under 18. The third quarter, they bought 19 million. The following quarter, they bought just under 19 million. And then this past quarter, the 5th quarter of buybacks in total, they bought back 18 million. So I'm like, you're kind of keeping it flat at 18 million, yet, as you showed, they're distributing on a quarterly basis over $100 million worth of stock out to the employees. And I'm not saying don't give employees share-based compensation. I'm just saying grow the amount of repurchases to at least try to offset. I mean, we think the share price is skyrocketed now. The share price has skyrocketed with Palantir, even while they've continued to expand the underlying shares outstanding. Imagine once they actually offset that and start to buy back stock at a net negative, right, where they're actually allowing it to actually reduce the share count. But anyway,
yeah,
I know way too much about it.
Yeah, the share count's growing at about 6% per year right now. But if you think about it, it's actually a good idea to issue all of these suckers new RSUs to employees. You know, why not pay employees with overvalued stock?
Yeah.
I mean, isn't that a good business practice from an executive standpoint? Right? Be like, hey, listen, here's your RSU package. You know, the stock is worth $144 a share, and it's grossly overvalued. So you're basically paying them with monopoly money.
Yeah.
Short-term monopoly money. Long-term, it could actually be worth, what it's actually worth. But, if you can pay someone with shares and not cash, because cash goes out the door, you're not seeing that back. With shares, let's say they paid someone, they hired an engineer and said, look, I'll give you $500,000 in RSUs to attract you. And then the stock goes down by 50% to 250, let's say 250,000. You got yourself a $500,000 coder for half the price.
Yeah.
Right.
Yeah. I mean, these guys have booked at this point. I mean, here's the revenue growth. I mean, and this last thing I'll say on Palantir, sorry, I just need to complete my thought. They've kind of built themselves into a corner. Like if they don't hit 30, they have forecasted for the second quarter 38% revenue growth is what they've kind of forecasted. They hit 39% in the first quarter of 2025, and they forecasted 38 for the second quarter of 2025. If they don't hit 38 and they actually go at 37 or anything like that, it's not going to look good. But in reality, I think if they don't hit 40 in the second quarter, they might get forgiven. I wouldn't be surprised if they get forgiven, but with this trajectory, what you're seeing, like if they don't go back to 40% growth in the shorter term, it's not going to look good for the share price.
If anything, if it goes in the other direction also continuously, that could be a major problem as well. So I guess as a shareholder, keep your eye on that revenue growth rate, because a lot of what we're seeing today is front running of a lot of growth expectations. So if growth expectations start to, come down, that means that the stock itself is going to get revalued big time. So,
other than that, I'm trying to think what other companies you wanted to talk to. I do want to actually finish the train of thought on the portfolio. Sorry, we went off on a tangent, but I think it was fun to talk about Palantir. I skipped last week's Palantir Weekly, so it's nice to get my Palantir in for the week. ASDS has been on a run, 74% or so. Rocket Lab's been doing good, 56%. United's kind of just hanging out there. What else? Carnival's up at 50%. Bitcoin's at 45%. I'm waiting for this to blow past 110,000. Hopefully we get closer to 150 before we start to enter crypto winter. Oh, somebody asked about Coinbase. I personally am not investing in like a Hood or a Coinbase until we hit crypto winter. Whether or not that is a good idea or not, the thing I need to do more due diligence on is how much revenue comes from for Hood specifically. How much revenue comes from particularly the crypto commissions on the Hood side. Obviously, Coinbase is going to get decimated if we enter some sort of crypto winter, and that's when I actually plan on buying positions. Roy and I talked about this extensively at lunch today. It's like I am a big believer that crypto winter is going to be coming within the next 12 months or so. So I'm not going to be buying these cyclical crypto stocks here when I can wait, hopefully, and purchase them at a better price in 12 to 24 months. So there's that. Do you have any thoughts on Bitcoin? I saw that you wanted Google to start putting treasury in Bitcoin.
Well, no, my thing with Google is that Google is so undervalued relative to their cash flows. And it seems like the companies that seem to be getting huge premiums are the Bitcoin treasury. So I'm like, Google could, let's say, instead of spending 70 billion on share buybacks, they do 60 billion and buy 10 billion of Bitcoin and just hold it on the balance sheet. Now, all of a sudden, everyone's like, oh my God, Google's making all this money and they've got all this Bitcoin. So it's like, let me throw some money at Google because they've got that 10 billion. And you know what I mean? It's that perception. Mm-hmm. So, and Google could buy theoretically $70 billion of Bitcoin a year right now if they really wanted to. I mean, it would take drastic change, and I think no one would like it, because Bitcoin is still considered on Wall Street rat poison. But it would be a very interesting thing to see a whole bunch of people, investors, jumping in Google, because now it's like, oh, Google just turned itself into a Bitcoin treasury company. It was just a funny thought. I wouldn't hope Google would go that route. But
I kind of hope they would, personally. Yeah, I personally would. Thoughts on Norwegian? I mean, we don't have the best return on this bad boy, but yet, it's still.
So I'll explain what happened between Norwegian and Carnival. So both of them, their end goal, of course, was to bring shareholder value. Carnival said, we're not going to build new ships because we have a ton of ships already. Instead, what we're going to do is focus on conserving our cash, paying down our debt, right? So that this way we get a boost on the bottom line. Norwegian did something different. They're a much smaller company. They said, no, our goal is we're going to grow. So what we're going to do is we're going to grow our EBITDA significantly. But that also means that we're going to take on a lot more debt. So if you look at the debt for Norwegian, it's relatively flat because their earnings are growing, but their debt is flat because all the money that they're getting right now, it's going into new ships, right? And basically building their fleet. So let me just show one thing right here. And once you see it, you'll understand what the value proposition of Norwegian is. One second.
I love the Norwegian commercials. They get me fired
Yeah.
up. Where they're like, "Cruise like a Norwegian." Anyway, I
Really?
just think,
I'm seeing any.
well, you got to watch it. I don't want to get
Yeah.
demonetized, but shit's wild.
Okay.
It gets me fired up.
Okay. So if you look at Norwegian Cruise Lines, if you look at their revenue growth, look at this. Let's look on a TTM basis. Their revenue has gone from $3.7 billion in 2015, right? It's almost $4 billion in 2015 to now almost 9.4 billion. So you can see this huge growth in revenue. And even on the operating income side, they're generating the same amount of operating income that they were generating before COVID. Okay. The challenge is they issued a lot of debt, but issued a lot of shares, but more importantly, they also issued a lot of debt. So if you look at Norwegian's debt on their balance sheet right here, unlike Carnival, whose debt is growing down, if you look at Norwegian's debt, it's staying up there at 12. Like right now, it's at 12.87 billion because they just got a new ship. So you can see here on their balance sheet, you don't see that debt reduction, right? So that means that the cash flows that they're generating, that the additional cash flows that they're getting, instead of going towards long-term shareholder value, they're going towards growth initiatives. And the thing is, the interest rate that they're paying on their debt is, it's pretty significant. Now, the challenge is if you look at Norwegian and let me just look at NCLH Investor. If you look at their debt, let me just look at their presentation. By the way, Norwegian is a lot more luxury than it is like Spirit Airlines. So I would think of Norwegian as more like Delta, relative to Carnival, which is more like Spirit. But let's see this right here. This is a major problem that Norwegian has. So you can see here that they owe 7 billion in 2025, another billion in 2026, and then in 2027 they have a maturity wall of 3.4 billion. And then you can see here. So they've been basically leveraging much higher amounts. So you can see it went from 7.3 times EBITDA in 2023 to 5.3, and now it's back up to 5.7. And even by the end of 2026, they're expecting mid fours. So if you look at Carnival's already in the threes. These guys are expecting EBITDA to grow, but their debt is going to be there also. So eventually their goal is to get back down to much more manageable levels. But the longer interest rates stay higher, the more likely it is that the debt that they basically take on, because remember, they're always going to recycle debt, is going to be higher. So instead of that money falling to the bottom line, it basically goes towards interest expenses. So that's the key difference between Norwegian and Carnival strategy. Carnival said, we're going to pay down our debt so that we become better in terms of as a creditor, and then using that increase in credit rating, we'll be able to keep lowering our debt with lower interest costs. Norwegian bet that we were going to get interest rate cuts from the Fed, in which case overall corporate interest rates will come down, right? That didn't happen. Instead, interest rates stayed higher for longer. So that's why Carnival actually started to outperform Norwegian. So if you look at CCL versus NCLH, let's just look at it. CCL and compared to NCLH. In terms
of stock price, or
yeah. So their stock performance, you can see a divergence from there. So let's do that. Just share my screen. So you can see here a 1-year chart of Norwegian and Carnival. Sorry, a 1-year stock chart. You could see they were pretty much humming along right next to each other. You see that?
Mm-hmm.
And all the way until April, they kept humming along in sync. The difference is after April 7th, it kind of became, what's the word? It kind of became the expectation became that interest rates were going to stay higher for longer. And so what happened? The strategy of paying down debt became infinitely more profitable than, hey, let's just grow. Doesn't matter how much debt we take on or how much debt we maintain. And so this is where Norwegian has kind of been falling back a little bit. You see that in terms
but do you
of growth?
think investing through the cycle for Norwegian will eventually play tailwinds in the next 3 to 4 years as they kind of get their EBITDA up and they have the ability to pay it down. I mean, do you think that net long term Norwegian will kind of come back and potentially surpass the market cap growth of say a Carnival, or do you think they'll be end up in the same place?
Oh, I think Norwegian has it right, but they need a lower interest rate environment to be right. Carnival just needs to basically keep performing the way that they're performing, you know? So I think eventually you can see this divergence. I think this divergence is going to close eventually, right? But it's just a matter of, hey, where interest rates are going to go. So it really comes down to how the companies maintain costs and also at the same time what the current interest rate environment looks like. The other thing that Norwegian has is they have a lot of debt that's actually adjustable rate. So it's floating rate debt. So floating rate debt, if interest rates stay high, you keep paying, right? So if interest rates get cut, you save interest, right, on that floating rate debt. That's the challenge, where Carnival has a lot more fixed debt. So it was like, okay, we're only going to pay this fixed amount, and as we pay it down, it's gonna, our interest profile is going to get better. Norwegian,
and I don't think Norwegian's had the upgrades as much though in terms of debt, right?
No, it hasn't. It hasn't, because its debt hasn't gone down. Its EBITDA has grown, but the debt hasn't gone up nearly. I mean, the debt hasn't come down. So, and the thing is, if you look at their trajectory for Norwegian in terms of like building, let me show you. And
that's what I'm talking about. Like they're investing through, I don't want to say this, the cycle is the wrong term. I'm using oil and gas technology oil and gas terminology there. But when I'm talking about investing through the cycle, I mean, even though they have high debt and they should be paying it down, obviously the pandemic caused them to have a pause in revenue growth and things of the like. What I'm talking about is Norwegian isn't stopping building new boats. And so throughout the next few years, they're going to continue to get more and more boats in, which is going to increase their EBITDA, which will allow them to hopefully decrease their debt to EBITDA, because obviously if their EBITDA is growing, and that'll make it more digestible from that perspective versus where Carnival is. Carnival's kind of put a pause on new boats. And so their EBITDA is not going to grow as much. The way that their EBITDA can grow, though, is if they, I guess it's before interest, taxes, depreciation. So they're probably limited in terms of that. So all they can do is get their net debt down, and kind of grow the strength of the company. But eventually they need to get to a place where they're issuing more boats. Otherwise their EBITDA is going to stay kind of. So that's why I'm kind of asking, will Norwegian eventually surpass Carnival again?
So Carnival did a couple of things that actually is somewhat growthy. One of the investments that they made was the new island that they built in the Caribbean, right? So the total cost of that island is a lot less than the total projected outcome in revenue and EBITDA that they were going to get. So that was one major thing that Carnival did, which is they really invested in sort of in a different segment of the industry that worked out really well. And believe it or not, one of the pioneers of this was Royal Caribbean, who had a private island called Coco Cay. If you've ever taken a Royal Caribbean, like trip in the Caribbean, there's a stopover in this one private island that Royal Caribbean has called Coco Cay. It's called Perfect Day at Coco Cay. It's actually really fun. Like they have like a water park. They got a bunch of pools. Carnival did the same exact thing, except I think they went a little bit heavier. And if you look at their new park, it's freaking crazy. It's amazing. And they have a shack. I mean, I think we should watch a commercial, but I'll try to just mute it. But you can see here, Norwegian is really in heavy building mode, and they've got new ship deliveries almost every single year. And I'm not talking about these boats are about $1 billion, five. They are not cheap to build. So imagine every year you're generating, let's say, 2 to 3 billion in EBITDA, but about $1 billion of that is going towards CapEx, right? And then the year after that, your EBITDA is going to grow, but then your CapEx is going to keep growing along with it. Overall, Norwegian would see huge tailwinds if interest rates got cut, because that means that they're financing the new boats at cheaper prices, which once again, that interest savings falls to the bottom line. So,
man, that
yeah.
thunder over there is getting pretty well.
Yeah. If I get cut off, then yeah.
It's either one of two things. Boss lady came in and attacked you, or the thunder finally got you.
Yeah.
Interesting. Well, let's do a quick. If you're finished on the cruise, are you finished on the cruise lines?
Yeah, I'm finished on it.
Okay, perfect. That was really good. I always appreciate your knowledge around that because I don't follow it nearly as much. But portfolio performance over the year to date time period, as well as the last trailing 12 months here on the slide. Apologies, it's not as well. Normally I try to make the format so it's everything kind of aligns, but I'm an idiot today. But on the left hand side, you can see year to date. So we're up 32% year to date in the public portfolio. And for the trailing 12 months, we're up 71%, which is great. Overall, I mean, man, beating the market by over 50%. No small feat. That's what, if you were to multiply that out, it's almost a 5x comparatively to the S&P over the past year. So from 13% to 71%. Pretty good. Can't complain with that. And I think we've had a lot of love, and we've made some folks some good opportunities in the portfolio. Any thoughts on this, Mr. Patel?
No, I think we're doing good, man. Just keep beating dude, we're up 70% in our 1 year performance. It's freaking great.
Yeah, that's crazy.
I
wasn't it wasn't looking very good 2-3 months ago during the tariff talk, and then we moved into VG, and VG really
juiced it for us.
Yeah.
I do want to divest some VG and actually put it into next decade. I kind of mentioned this a little bit before on my Patreon, but I think it's not a bad idea to do that. Especially when it was like at like 19 something, because my price target for these guys by the end of 2026 is like $22, $23. Because remember, this is still a $40 billion company at $16. So if you think about it, 25% is going to be what, like 50 something billion, which is the same size as Cheniere, right? And Cheniere is, pretty closely aligned with their metrics right now until they get some clarity on CP2's total EBITDA, because remember, they're doing a lot of spot contracts. So they're more exposed than what do you call it?
Cheniere.
Than Cheniere. By the way, Cheniere announced that they're actually expanding Corpus Christi, which is interesting too. So,
Yeah, Corpus Christi as well as Sabine Pass. I think they're going to add another 10 MTPA. Potentially it's Sabine Pass, and then another 10 or 15 or so. So they're at 50 MTPA total, I think, capacity right now. So they'll end up at about 75 MTPA overall, which means I think that they're going to grow the market cap probably closer to 70 billion. So for those guys that are interested, there's that. But I think it'll probably take until 2028, 2029. They do. We're used to now looking at things on a VG timeline, and VG delivers things in about half the time. So in that respect, people are like, oh, if you think about it, think of Next and Cheniere as the traditional old way of doing things. It's going to take some time to potentially get that volume actually through the pipe. So they're sanctioning it, or at least getting ready to sanction the Corpus Christi expansion and the Sabine Pass expansion, but it'll take some time before it really gets there.
Yeah, so as I was saying, I think a little bit of divesting from VG and dropping some of it into next decade to hedge our LNG bets might not be a bad idea, especially if we get like a next decade pullback back into the 8s again on the war resolving, because I think that's one of the things. So long term, my price target on next decade by, let's say, 2030 is, depending on how much equity they're able to maintain, is about $80 a share, which would put them about 20 billion in market cap, roughly. Because at that point they'll be doing what, 1 to 1.3 billion in distributable cash flow, right? So if you multiply that out by, by, let's say 15 times, that gives you about 20 billion in valuation at $80 a share. And that's probably after, that's probably with some share buybacks that they'll probably end up doing way out into the future. So, if your time horizon is like 5, like I tell anyone with next decade, look, don't focus on, oh my God, next decade went up by, 10%. Like, look at it in 2035 terms. Because by that time, you'll get a nice 5 to 10x on the position, so.
Yeah, let me share this graphic, and this is why I think we're still early a little bit on BG to an extent. This is how quickly it's ramped up over the past 6 months. So I'm curious, they've ramped up to above, 30-40% above the first tranche of capacity. So I'm not sure what this is, if they're connecting up the second tranche of trains to expand, because by year end, I think this is supposed to be 28-ish MTPA, which is how much BCF a day? 28 times 48 divided by
Tevis never loved us?
Yes, I'm sorry. I shouldn't be sharing all my DMs. But yes, I changed it to that because Tevis refuses to invite me to what is it? Bootleg Weekly or something like that. But yes, Tevis never loved us. This should be going from about 2.7, 2.8 BCF a day to eventually being about 3.7. So we still have a pretty good chunk. So let's just see, 2.75. Whoops, that's not what I wanted. 3.7 divided by 2.75. We have about a 35% increase from where we are today as to what this should look like. So it'll be good. It'll be good to see what ends up happening.
Yeah.
Cool. What I will say is this is our best episode yet, man. We had over 350 people live right now here on YouTube. That's a record for us. We normally have been hovering in the mid 200s. So the fact that we've been able to sustain over 300, I appreciate that. I'm not exactly sure where that came from, but as always, we love having you guys on and really appreciate the banter back and forth. And we hope to grow this for a long time. And, it being our best episode just goes to show that the best is yet to come for the Cashflow Chronicles. Mr. Patel, thank you as always. Any last final words?
Yeah, I think we've done so well. The expectations for us is growing. I was telling someone about next decade, and they're like, wait, what do you mean that it's not going to like double this year? So I was like, come on, guy.
No.
Everyone now is looking for that 5x in 5 months kind of stock, right? And so a lot of people are looking at like Circle. They're like, man, one guy told me, how come you didn't pick up on Circle that it was going to blow up like this? I was like, I don't know anything about it like that, So I think so many people, they've got 5Xs in such a short period of time that now the expectation is, what do you mean only 100%? Bro, that's nothing.
Right. Yeah. That's part of it. And I think it's times like this where it makes me a little weary in terms of what people's expectations are and how people's portfolios are, because I think everyone's just like, oh yeah, I'll put in, $100,000 and $100,000 will turn into $2 million in the next 3 to 4 years. And it's like, no, my guy, it doesn't normally walk that way. So hopefully people's,
expectations get dialed back a little.
Exactly. Feels very 2021-ish to an extent, but at least right now it feels like some of the earnings, some of the companies are really out there, Palantir, etc. But some of the companies deserve it, and then you have some companies that are undervalued, like Google. So,
and I think that's the sad part, though, right? Because it's like, what happens is you'll get into a position and it'll be like a month, and it's like, why? How come the stock hasn't gone up 10% yet, or 20%, or 50%? And I'm floored by a question like that. I'm like, well, there hasn't been any real material changes, so it's not going to do that. So I think that instant gratification, hopefully people realize that it's time to kind of dial that back a little bit, and even with interest rate cuts. That doesn't necessarily mean like, hey, listen, the entire market's gonna rip when interest rates come down. Most of the time when interest rates come down, things actually start to go in the other direction. So I know from a business standpoint, some companies will benefit, but there's a lot of companies that may end up not doing as much. And the onus on interest rate cuts is usually like when things are not good. You know what I mean? Like we've had a lot of growth over the last few years, so it's kind of like, oh yeah, this was to be expected. So it's funny, like I mentioned like a company or an industry like like natural gas, and they're like, but how does that relate to AI? And I'm like, it doesn't. Oh, okay, then I don't want to touch it. I just want to be an AI. I'm like, okay, that's cool, I guess. It's like, are they doing anything with AI? Are they discovering new liquid natural gas with AI? I'm like, no, they're not. They're they're just liquefying it.
Just liquefied natural gas. Yeah, I don't know.
The other funny question that I tend to get: can they work with Palantir to improve like every company? One of the bull cases on UNH that everyone's been throwing around. Yeah, Palantir works with UNH, so UNH is going to be fine. So it's almost like, hey, we're going to bet on UNH, not because it's a strong company with 400,000 employees that's in an industry that's heavily regulated, that doesn't allow a lot of other competitors to come in. It's because they work with Palantir. I'm going to buy the stock. I'm like, whatever gets you to buy it, I guess.
Yeah, whatever makes you feel comfortable at the end of the day. So
yeah.
Anyway,
AI data centers run on LNG generators. Pure AI play. Nice.
100%. 100%. All right. Thank you, everybody. The next time we might try to do an episode in Cancun if we have the opportunity. It'll be a good time. I don't know if I'm bringing a mic or not, so that might be a hard part. How we actually do an episode without a mic, but
I'll bring my MacBook. My MacBook, the mic is really good. It's actually, there's this feature on it that does like noise cancellation and everything else, and it's really good. Like whenever I go on Amit streams in the morning and I listen back to the conversation, I'm like, man, I have a better mic than Amit does, and it's just the MacBook mic, surprisingly. So yeah.
There you go. All right, interesting. Thank you guys. Hopefully you guys enjoyed. We'll talk to you guys soon. Cheers.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.